Hello everyone, welcome back to Wealthy Cash Cow. If you're new here, don't forget to hit that subscribe button and the notification bell so you never miss out on our valuable content. When you start investing on your own, the world of investing may seem wide, often too wide. But you can simplify things with some time-tested strategies. These popular investment choices can help you achieve a variety of financial goals and help set you up for a lifetime of financial security. Here are 5 popular investment strategies for beginners, along with some of their advantages and risks. Whether you're just starting or looking to refine your approach, this video is for you. So, let's get started. Number 1. Buy and hold. A buy and hold strategy is a classic that's proven itself over and over. With this strategy, you do exactly what the name suggests. You buy an investment and then hold it indefinitely. Ideally, you'll never sell the investment, but you should look to own it for at least 3 to 5 years. Advantages. The buy and hold strategy focuses you on the long term and thinking like an owner, so you avoid the active trading that hurts the returns of most investors. Your success depends on how the underlying business performs over time, and this is how you can ultimately find the stock market's biggest winners and possibly earn hundreds of times your original investment. Risks. To succeed with this strategy, you'll need to avoid the temptation to sell when the market gets rough. You'll have to endure the market's sometimes steep falls, and a 50% or greater drop is possible, with individual stocks potentially falling even more. That's easier said than done. Number 2. Buy index funds. This strategy is all about finding an attractive stock index, and then buying an index fund based on it. 2 popular indexes are the Standard & Poor's 500 and the Nasdaq Composite. Each has many of the market's top stocks, giving you a well-diversified collection of investments, even if it's the only investment you own. Rather than trying to beat the market, you simply own the market through the fund and get its returns. Advantages. Buying an index fund is a simple approach that can yield great results, especially when you pair it with a buy and hold mentality. Your return will be the weighted average of the index's assets. And with a diversified portfolio, you'll have lower risk than owning just a few stocks. Risks. Investing in stocks can be risky, but owning a diversified portfolio of stocks is considered a safer way to do it. But if you want to achieve the market's long-term returns, an average 10% annually for the S&P 500, you'll need to hold on through the tough times and not sell. Number 3. Index and a few. The index and a few strategy is a way to use the index fund strategy and then add a few small positions to the portfolio. For example, you might have 94% of your money in index funds and 3% in each of Apple and Amazon if you think those companies are well positioned for the long term. Advantages. This strategy takes the best of the index fund strategy, lower risk, less work, good potential returns, and lets the more ambitious investors add a few positions. The individual positions can help beginners get their feet wet on analyzing and investing in stocks, while not costing too much if these investments don't work out well. Risks. As long as the individual positions remain a relatively small portion of the portfolio, the risks here are mostly the same as buying the index. You'll still tend to get around the market's average return, unless you own a lot of really good or poor individual stocks. Number 4. Income investing. Income investing is owning investments that produce cash payouts, often dividend stocks and bonds. Part of your return comes in the form of hard cash, which you can use for anything you want, or you can reinvest the payouts into more stocks and bonds. If you own income stocks, you could also still enjoy the benefits of capital gains in addition to the cash income. Advantages. You can easily implement an income investing strategy using index funds or other income-focused funds, so you don't have to pick individual stocks and bonds here. Risks. While lower risk than stocks generally, income stocks are still stocks, so they can fall too. And if you're investing in individual stocks, they can cut their dividends, even to zero, leaving you with no payout and a capital loss as well. Number 5. Dollar cost averaging. Dollar cost averaging is the practice of adding money into your investments at regular intervals. For example, you may determine that you can invest $500 a month, so each month you put $500 to work, regardless of what the market is doing. Or maybe you add $125 each week instead. By regularly purchasing an investment, you're spreading out your buy points. Advantages. By spreading out your buy points, you're avoiding the risk of timing the market, meaning the risk of dumping all your money in at once. Dollar cost averaging means you'll get an average purchase price over time, ensuring that you're not buying too high. Risks. While the consistent method of dollar cost averaging helps you avoid going all in at exactly the wrong time, it also means you won't go all in at exactly the right time, so you're unlikely to end up with the highest possible returns on your investment. There you have it, folks. Some top investment strategies for beginners. Remember, investing is a journey, not a race. Take your time, stay disciplined, and always reassess your strategy as your financial goals evolve. If you found this video helpful, don't forget to give it a thumbs up and share it with anyone who might benefit. As always, thanks for tuning in to Wealth Cash Cow. Happy investing.